also, so that day somebody pointed it that there are 7 domestic credit rating agencies. Yes, there are 7 as per the, I checked the RBI circular of April 2022. So in that circular also it is mentioned that there are 7 rating agencies as of now. Okay, so these are the 7 rating agencies. Okay, now next one is another thing somebody asked that day. I actually that was my part of mistake. Somebody asked, what about the staff housing loans? What is the risk weight for staff housing loans? Now, I have also gone through April 2022 Master Circular of RBI, where it is clearly mentioned that even a housing loan for staff also, which are secured by mortgage of flat or house, they will have 20% of risk weight. So I changed that. You can read it. Staff loans fully covered by superannuation benefits, or that is PA for pension, and or mortgage of a flat or house. That means housing loans comes to that thing. So they will attract 20%. That day I told that no, it will attract 70 as per this housing loan concept. But now I am clarifying that even staff housing loans also will have 20% risk weight. If any other loan given to staff which are not covered by superannuation benefit or mortgage of house, then they will carry 75% of risk weight. Okay, so these 2 corrections I am making, so please make note of it. Now we have completed up to non-performing asset. So whatever the credit risk weight we are discussing. So we have discussed about 5 major categories. That is, bank can give a loan to government, bank can give a loan to banks, bank can give loan to corporates, bank can give it to retail and NPA portfolio. These are the 5 portfolios. So all these 5 portfolios or 5 categories of loans or exposure, 5 exposures we have discussed. This we have discussed about when the bank is giving funded loans. Means funded advance. But bank also provide non-fund advances. Non-fund advance means like your bank guarantee, LC, and other derivatives, etc. Whatever non-fund advances will be there, bank can provide those advances also. So for those non-funded advances, what is the procedure? Procedure to calculate the capital. We know the formula. Simply for funded advance formula, I told you that capital equal to exposure multiplied by risk weight multiplied by capital adequacy ratio. This is the formula. Okay. And risk weight, whatever I told you for the fund base, risk weight will remain same for non-funded. There is no change in the risk weight. Risk weight is for the same. It will remain same. Like government, what is the prescription is there? Banks, what is the prescription is there? Corporate, as per rating, what is the prescription in the RBI risk weight? Then retail also same thing. Now LP also same thing. So risk weight will not change. Only the formula for calculation of capital will change a little bit. So what is that change? Change is that another factor will be multiplied with this formula. Because the logic is that whenever any bank guarantee is given, this is a non-funded. Bank guarantee is given means bank guarantee is issued on paper only. On paper only by the bank. Because it does not affect bank's balance sheet. there is nothing created in the balance sheet. When loan is given to somebody, or loan or advance is given to somebody, that means what? In the balance sheet, in the asset side column, something is created and asset increases. Okay, when loan gets repaid, asset decreases. So that happens. But when the bank guarantee is issued, there is no entry in the balance sheet. It doesn't affect right now. So that's why they are called non-funded. Bank has not funded anything to the borrower now. But in future, if there is a failure of commitment by the borrower or the applicant or the counterparty, we call the applicant is the counterparty, who fails in the commitment of honoring those things to the beneficiary. In such cases, beneficiary of the bank guarantee will invoke the guarantee and bank has to pay that guarantee immediately by creating a loan. In the books of accounts. So when a loan is created, automatically it will come to the balance sheet, asset will be created or asset will increase. So there is a possibility that when bank guarantee issued, it is not guaranteed that it will be always remaining non-funded. There might be a failure of commitment by the counterparty and it may become a funded. It may become funded loan or funded advance. So in such cases, when it becomes funded, there is a risk involved. So that's why RBI says, or Basel says that for non-funded advance also, we have to maintain capital. But capital will be little bit lesser than this one. Maybe it might be lesser than this loan, where we know that what is the exact amount we have given. But in bank guarantee, we do not know whether it will be given or not. So that's why the formula will change like this. So I'll tell that formula will be capital equal to exposure multiplied by another factor which is called CCF. CCF is credit conversion factor. Credit conversion factor. That CCF is given by RBI. That is constant like risk weight. Okay, it is a percentage again. Multiplied by a risk weight multiplied by capital adequacy ratio. So only this thing is introduced. In non-fund advance, only one thing which is called CCF has to be multiplied and extra. For fund based, it is not required, only non-fund based. Am I clear to all of you? So what is CCF? I'll just let you know. Do you understood this formula?
Yes, sir.
Yes, sir. Yes, sir.
Okay, fine. Now I'll show you what are the important bank guarantees, important non-fund advances, or they are called off-balance sheet exposures, which are coming in the examination. Other than this, nothing will be mentioned in the examination. So we'll just look into this 3 CCF only. We'll deal with this CCF only. So first thing you read financial bank guarantees. So any bank guarantee or any kind of standby LC which are in the nature of financial guarantee issued by the bank, in that case CCF will be 100%. That means there is 100% risk, so 100% to be given. For guarantees or bonds which are performance guarantee in nature, so any bond or any indemnities or standby LC or any guarantee which are being issued by the bank, which are not in financial nature but they are performance guarantee in nature, in such cases CCF is coming down to 50%. And in case of letter of credit or letter of documentary credit, they are called LC. In that case, it is still reduced. CCF is 20%. Okay. So these are the three things you have to remember, like NPA. NPA, three things we have remembered. Now, this is the off-balance sheet exposure, financial bank guarantee, performance guarantee, and letter of credit. So if the question comes, you can easily decide what CCF is to be applicable and capital to be calculated. Okay? Can we move on?
Yes,
Any
sir.
question? Any doubt? Any question? No?
Standby LCs.
Standby LCs are like bank guarantees. They are not the letter of documentary the pure LC, but they serve as bank guarantee. When the bank guarantee given for a customer for overseas transactions, normally in that case, the term standby LC are used, or standby LC are just like bank guarantees. They are not pure LCs, but they are sort of bank guarantee, financial bank guarantees, or they can be performance bank guarantee also. Any other question?
So it for calculation and all, will it be given that standby LC is performance acting as performance guarantee?
Yes, always. Otherwise, you cannot differentiate now whether it is 100% or 50%. If it is a financial type of standby LC, I have written here. It includes standby LC serving as financial guarantee. So it will be given standby LC as financial guarantee or in financial nature. Standby LC as performance in nature. So it will be given. Otherwise, you cannot differentiate. Nah?
Yes.
Okay?
Okay, sir.
What
Now-
is the difference between financial bank guarantee and performance bonds guarantee?
Financial bank guarantee means normally whenever, suppose, see in bank guarantee what happens, there are three parties involved. Three parties. One is called applicant, who will be the customer. Then bank, that is the guarantor, bank guarantees, and there is a beneficiary. Beneficiary. Three people are involved in a guarantee, say bank guarantee. Now, say I told you that suppose applicant wants to do some business where he wants that beneficiary or the concern or vendor has to provide some kind of service to him so that he can do the business. Suppose, as I told you earlier, suppose beneficiary is say BSNL or Airtel, and this applicant wants to set up a say cyber cafe or a STD booth. STD booths are not so popular right now. Anything, just for example. In such case, what happens? BSNL or Airtel, they will tell applicant that so you have to deposit with me 50,000 rupees as security deposit, and I will give you the connection so you can start your business. And the bills which will be coming, which are post-paid, means you use it, then you have to pay. It is not a prepaid business. So you can pay the bills monthly or fortnightly. So in this case, what is the beneficiary or the vendor demanding? It is demanding finance from the applicant. So applicant can deposit that 50,000, or Airtel or BSNL says that if you do not want to deposit the cash with me, you can apply to your bank. Bank can give a bank guarantee of this amount to me. So in case what happens, applicant will deposit that 50,000 with the bank. will enjoy the interest on the bank as a fixed deposit. In lieu of what, the bank will keep that fixed deposit under lien and will issue the bank guarantee. So here it means it is a financial bank guarantee, because bank guarantee has given against a finance of 50,000, which is actually the beneficiary is demanding from the applicant. That is financial bank guarantee. So any kind of business transaction where the applicant is supposed to deposit some type of security money or earnest money or whatever, that time, instead of depositing that with the beneficiary, the applicant may deposit that amount with the bank, so that bank can issue a bank guarantee, which is as good as the promise that whenever beneficiary wants, he can invoke the guarantee, he can come to the bank with the original guarantee paper, bank will pay the amount immediately without asking anything to the applicant. So that is the financial bank. Now, in case of performance guarantee, what happens? Sometimes the beneficiary is a government and an applicant is a contractor. So this contractor gets the contract from the government for building a, say, road or dam or any other project which government says that this project has to be completed within a period of 3 years. If you can complete this within a period of 3 years, then full payment will be released to you. If you do not finish this one, then I may not give you the full payment. So there is a penalty involved. So in that case, suppose the cost of project is whatever it will be. So for that, government says that the total project cost will be this much. So for 3 years period, you have to complete this project. Now you give me a bank guarantee for, say, rupees 1 crore. So that I will be giving you the contract, it will be there. So now this bank guarantee has been issued by the bank to the on behalf of contract to the beneficiary, that he will be completing to the project within a period of 3 years. Otherwise, it will be invoked by the government. So that will be amount of bank guarantee. A bank guarantee has always an amount. Say 1 crore is the amount. Now here the main thing is completion of project. So that means it is the performance of the applicant. So when the performance is failed, then government will invoke the guarantee. So that is the difference between financial bank guarantee and performance bank guarantee. Is it clear?
Okay, sir. Thank you.
Okay, now still more things are there in credit risk. So now on, please focus on what I am telling, and wherever you find doubt, you just ask me. Now we know that capital formula is exposure multiplied by risk weight multiplied by CAR. These are for funded exposure. For non-funded exposure, C is equal to capital equal to exposure into CCF into risk weight into CAR. These are the two formula you must have remembered by now. Okay, now we are calculating capital of credit risk by applying this formula. Now we know that this is prescribed by RBI. Either this is 9% or with CCF it is 11.5%. So this is not going to change. As per the requirement, we will put either 9 or 11.5. Or whenever sometimes asked what is the tier 1 capital required for the bank. So what is the percentage to put? Tier 1 capital. How much is the tier 1 capital? CR?
7.
Very good, 7%. What? Tier 2 capital?
9. 2%.
2%. CET1 capital?
5.5.
Very good. And additional tier 1?
1.5.
1.5.
So whenever he is asked what is the CET1 capital calculation, so in such cases the CAR will be 5.5. whenever they are specifically asking. When I was asking total capital is 9%. When they will ask total capital with CCV, then you have to put 11.5. Okay, so these are the basic things we should learn. So now another two steps has to be followed. So we have to see. So here formula is, say we are talking about funded exposure multiplied by risk weight multiplied by CR. As CR is constant, risk weight is also constant because risk weight is assigned by RBI. So we know only thing what will change is exposure. Means which loan we are taking, how it will be, which amount it will be. So according to based on this exposure, capital will be changing also. For this loan, this much of capital. For that loan, that much of capital. Like this. Now, they are not changeable. Now, this exposure, what exposure? What is the actual amount we should take? What is the actual amount we must take? What is the actual amount we must take? So for that, two adjustments are required to be made. Depending on the type, depending on the type of exposure. Second, depending on type of collateral security available. So, two adjustments may be there as per type of exposure, as per type of collateral security available. So, further adjustment to exposure has to be made to find out, we are finding the net exposure, which will be the final exposure to be taken for calculation of capital. After this adjustment, two adjustments, if they are at all required to be made. If such conditions are there, then we have to make such two adjustments. Okay, so for that, the thing is that two adjustments are called. First is called adjusted exposure. Means exposure has to be adjusted and on the type of exposure or type of loan. Second is allowable reduction. So this will be according to the type of collateral available. If there is something is there which can reduce the amount of exposure. Okay, so this is one adjustment. This is another adjustment has to be made. Fine. So now I will discuss the first one. So adjusted exposure. This is based on type of exposure or type of loan. So type of loan, when I'm telling, there might be just two types of, we can categorize loans into two types. One type of loan are a running account type. Running account type. Another is loan type. So running account type, we can call them advances, and loan type are called loans. So what are the running account type loans we give?
Cash credit,
Yes.
overdraft.
Overdraft. Anything else?
PCL.
Packing credit. Okay. So basically these three are a running account. A loan means normally either a demand loan or a term loan or a bill purchase or bill discount. Like this, they are loan. Loan means only once it will be disbursed in full, then only repayment are to be made. But here the running account means there is a continuous process of withdrawal as well as deposit of the process. So that is the two difference between the loan, type of loan we give. So what is the purpose? I'm telling you that suppose normally this calculation of capital, generally it is done on a single day. Say generally it is done. So at the end of the year, say on 31st March of 2022, we'll take all the balances of our loan account and calculate the capital for the future 1 year period. So on the balances as on last March, on 1st of April, we will calculate the capital required for each and every loan for the bank. Okay. Now, in case of CCOD account, what will happen? Suppose on this date, we are taking the balance. Now, CCOD and packing credit, they have a clear-cut sanction limit as well as drawing power. Suppose sanction limit or drawing power is say 100. But as on 31st March 2022, the balance outstanding in the loan account is say 60 rupees only. That means what? Our system will take 60 rupees as balance and 60 rupees the calculation of capital will be made. If that is done, that means less 40 rupees we are not taking into consideration, which can be used by the borrower. Since these are CC or OD account, he can avail this facility. So this 40 rupees is called undrawn or unavailed amount, which may be withdrawn on 2nd of April or 3rd of April or any other time during the year. So we are not taking into consideration. We are taking a less amount, which is as on that date it is available. So for that purpose, RBI says that no, this way you can take the 60 fine, but you have to also add a notional amount of this undrawn and unavailable amount, because there is a possibility that this amount may be withdrawn by the borrower in future. So what is the rule? So here the rule says for CCOD, you remember this rule says, you have to take so we are talking about adjusted exposure. So here, what is the exposure as on last date we are taking? So that has to be taken plus 20% of the undrawn or unavailed amount. That has to be added. So how much it will be? 60 plus 20% of 40. So it is 60.
12, 70. 8. Sorry.
Sir, screen is not visible, sir.
Anybody else?
Visible, sir.
Visible. Please check your device, because I am doing for the last, say, almost half an hour. I have
Okay.
just check it. Okay. So,
So, yes,
so this is the process. Yeah, tell me.
But when we announce our exposure or total advances figure, we are considering of our entire CCOD limit as an exposure, outstanding for term loan as a total exposure notion. This is only for the risk-weighted calculation or for entire calculation, I mean, even for disclosing of our advances.
No, this is only for calculation of capital.
Okay.
This whatever we are discussing, this is pertaining to calculation of capital only, nothing else.
Okay.
Sir, 60% actually I did not get it.
60% where it is?
No,
Where is
60,
60?
at 31st March 2022, 60.
This is the debit balance. They have drawn 60. Out of 100 sanction limit, they have availed only 60. They have not availed 40.
Okay.
Okay.
Yes.
So this unavailed person, 20% has to be taken as per the RBI direction. That is the rule. So you have to calculate 20% of that. Add 20% of the unavailed person. So it becomes 60 plus 8, 68. So in lieu of 60, in the formula, you have to take capital equal to exposure will be 68. Then you multiply the risk weight, multiply the capital adequacy ratio. Any other doubt on this? If you understood, then we'll go to the loan part.
Understood.
Okay, sir.
Okay, fine. Now, in case of loan, there might be also same type of situation where this unavailed person might not be there, but there might be some undisbursed person. Undisbursed person. Because whenever this term loan is or demand loan is sanctioned, bank sanctions this under certain terms and conditions that sometimes the term loan will be disbursed on different phases, on different dates. Different dates, different amount will be disbursed. Any type of project loan you take or any type of housing loan you take, that may be disbursed on more than one occasions. Say, first disbursement has taken place on 1st of January 2022. Say term loan, here I will say term loan has been sanctioned for 500 rupees or 500 lakh. First disbursement has taken place on 1st of January. Say 100 lakh has been disbursed. 100 rupees has been disbursed. Second disbursement will take place on 30th of November, 30th of September 2022. Say 150 will be disbursed here. Third disbursement will be made on say 30th of August 2023. So here also 100. Fourth disbursement will take place on 30th of March 2024. So this 500 will be total. Okay, so these are the approved sanction of the installment of 500 rupees, which is sanctioned by term loan. So that means bank has approved or confirmed that these are the different phases of installments. Now we are calculating the capital for this. So on 31st March 2022, we are calculating capital, means at that time only 100 rupees will be the outstanding debit balance in the term loan account, because they are yet to be disbursed. It will disburse in the September, it will be August 23, and this will be March 24. So they are yet to be disbursed, or these three are undisbursed amount. So here the rule says whatever already disbursed, that amount as on 31st March we are taking, so 100 we should take, plus 20% of the amount to be disbursed within 1 year from the date of first disbursement. So it is within 1 year, from the date of first disbursement to be taken 20%. Second thing will be taken 50% of the rest amount to be disbursed, irrespective of any time, which is more than 1 year from the date of disbursement. Is it clear?
Sir, 20, it means in 31st March, 100% disbursed, 100 disbursed, then 20% of the disbursed within 1 year. That means 20.
Yes, that means That means how much it will be? So it will be 100 plus
30
20%
plus
of
125.
20% of 150 into 50% of 250. Is it correct?
255.
Okay. So 100 plus 75 plus 125. So 100 plus 75 plus 125. So total becomes 300.
Sir, 150 is 30, 20 percentage. 150 is
Okay,
20
okay. So,
percentage means 30.
So 30,
30.
30, right?
30.
30 and 125. So it will be 275, right? 275. Okay. Sure.
Sir,
255.
sir, you are taking 20% of 150.
Yeah.
So 150 is 150 is dispersed within 1 year now.
Whether it is not disbursed within 1 year from the date of disbursement, first disbursement. What is the period of 1 year from the first disbursement? It will be 31/12/2022 only. So within this period, anything disbursed, that will be taken as 20%. So this one is the within 31st December 2022.
Okay.
Okay, because 23 becomes more than 1 year. 24 is still more than 1 year. So rest amount will be 50%. So here also 20%. Just logic is that anything which is drawn or disbursed within a period of 1 year, that will attract 20%. Because CCOD PC is normally sanctioned for a period of 1 year. More than 1 year, there is no concept of CC. Every year it has to be renewed. So only 20% concept is available for such CC and OD. But term loan may be disbursed after a period of 1 year also. For that, 50% has to be taken into account. And this is subject to the condition that in the question, if it is given that as per confirmed and approved sanction process of the bank, these are the different installments wise disbursement to be done by the bank. If such approved and confirmed sanction is not there, they will say that only term loan is 500 rupees and at presently it has the amount which is disbursed already disbursed at 200 rupees and within next year it will be disbursed 100 rupees. Rest we have, there is no mention. So only 300 rupees we know that is it. So for rest amount of 200 rupees, there is no sanctioned or confirmed mention of any phase of disbursement by the bank. In such cases, only this up to 20% has to be taken. This 50% for the rest amount we do not know. That means bank may not disburse that thing. So this has to be omitted. This will not take to be taken into consideration. Is it clear?
Yes, sir.
Okay, fine. Now we'll go to the next adjustment. Okay, the first adjustment is done. So according to the type of loan, if such things are available, you have to adjust that first. Okay, so here actually what happens, the undrawn or unavailed or undisbursed persons are added to the exposure. That has been done. The second thing is allowable reduction. What is that reduction? Reduction means there is some deduction is there. In adjusted exposure, we have added something, there is addition. But second one, some type of reduction will be there. Why that reduction is allowed? Because normally for any kind of loan, whether funded or non-funded loan, banks always takes normally some type of collateral securities. Collateral securities are taken by the bank, which are for the risk mitigation. Risk mitigation process means lowering the risk. So when you are taking this collateral security as a mitigation of the risk, that means the collateral security should be reduced from the exposure. Loan is exposure. So collateral security is C. So that means as per the type of collateral security, we can reduce the amount of collateral security from the exposure. Say 100 rupees is the exposure and we have say 80 rupees of collateral security available with us. That means 80 rupees is secured with us. So how much is the risky? Risky is only 20%, 20 rupees, because 100 rupees loan given, 80 rupees security available which can be sold by the bank, will receive 80 rupees minimum. So 20 rupees is risky. That means only on the risky part we have to calculate capital. This part is not necessary. So that is called allowable reduction. So that doesn't mean that all the collateral security value, what is a market value of that, entire amount is allowed to be deducted. RBI says that full amount cannot be deducted for all the thing. I will give you a rate at which you have to discount that and you have to adjust that part of collateral security to your exposure. Is it clear? So in such cases, this collateral security are termed as eligible financial collateral. Means all the collaterals are not applicable for such reduction. RBI has a complete list of financial collateral which are given with a percentage of discount so that those amount can only be deducted from the exposure amount. Okay, so these are the financial collateral available and a discount rate is given. That discount rate is called haircut.
Again, sir.
So-
Again, sir, please.
Can you remember I have something called revaluation reserve I have explained while taking into the capital element of CET1?
Yes, sir.
Yeah, 55% something.
So if the value of your property is 100 rupees, how much is allowed to be taken?
45.
So 55% deduction has to be, discount has to be done. So you can take only 45%, right? So here's the same thing. If the EFC is 100 rupees and the deduction amount is called haircut, this amount is 5%, how much you can take?
95.
95.
95 only. Simple case. Now, did you understand? What is haircut? You understood?
Yes, sir.
Yes.
Okay, so that is a simple thing. Haircut is the amount of deduction allowed for this one. Here, remember, when we are talking, haircut can be made, haircut is applicable to two things here also. Haircut is generally, we are talking about collateral, which are the eligible financial collateral. RBI keeps the list. Haircut can be also applicable to exposure. Sometimes to some exposure, haircut is also applied. It is also given by RBI. Entire haircut percentage are given. Always remember, whenever it is pertaining to collateral, haircut is a deduction or discount. So it will be deducted. Always that percentage has to be deducted from the collateral. Then what is the eligible amount that will be decided to be final deduction from the exposure. But when the haircut is given for a exposure, it is not a discount, it is an appreciation. So it will be a plus. Okay, sometimes some question comes for exposure also. So that time you should remember they will give a exposure and haircut. So at that time you have to add to that exposure. That haircut will be added to exposure. But in case of collateral, it has to be deducted from the collateral. Okay, can I move ahead?
Yes, please. How the
Okay.
exposure can be appreciated, how it can be added, because already we are adjusting the exposure.
Okay, so after adjustment, whatever, say 100 rupees was the balance you are taking as on 31st March. Now, after adjustment of CCOD, whatever, how much you have, right? Tell me. You tell me. You tell me any amount. You tell me, na? Any amount you
70
tell.
rupees.
70 rupees. Okay, it has become 70. Okay.
Yes,
Now,
yes.
for this, suppose the haircut for exposure is given by the question as say 5%. That
Okay.
means 70 plus 5% of 70 is how much?
35 almost.
3.5.
3.5.
So your exposure will become 73.50. Okay. For exposure, always remember, if there is a exposure haircut given, you have to add that. Collateral haircut is always to be
Deducted.
discounted. This is to be appreciated. Clear?
Yes.
Okay. Now, RBI says that some of the liquid securities like cash, bank FDs, you have sometimes gold is given as security, sometimes securities of government, state government or central government or state government bonds, etc. is given. Sometimes Kisan Vikas Patra issued by the post offices are given. Sometimes LIC policies issued by any insurance company having a declared surrender value. So in such cases, these are the full value collateral security. They are taken as full value. So RBI is told that this type of EFC will have 0% haircut. Means when it is 0% haircut means full value of all those things are deductible from the exposure. Other than that, for each and every security, RBI prescribes the haircut. Okay. Now I'll just tell you what are the formula, how to calculate. Now, another two things are there. So for till now, we have known about exposure. So exposure is denoted as E. Collateral is denoted as C. E and C. Exposure is denoted by E and C is the collateral. Haircut for exposure is denoted as HE, H and small e. Haircut for exposure, HE. Haircut for collateral is denoted as H small c. This much you remember. Okay. Now, another two situations will be there. First thing is that there is a exposure or the loan and there is a collateral, that is collateral security, or we call it EFC, as RBI calls it LFC. So these are the two things available. Now, first situation is that loan can be in one currency, say loan is on rupee, loan is given in rupee, and collateral is also rupee, first condition. So both loan and collateral are on the same currency. When it is in the same currency, we call it there is no mismatch of currency. So there is no mismatch of currency here because loan and collateral in same currency. But that might be possible that loan is given in rupee and collateral is in US dollar. So in this case, what is there? There is a currency mismatch. Third can be, loan can be in any other currency, dollar or euro, whatever is possible, dollar or euro, yen, whatever possible. And rupee can be, this collateral can be in rupee. So there is again a mismatch. Am I clear about this? These are the three possibilities. So when the loan and collateral are on same currency, we call it a position which is no mismatch. But when they are in different currency, there will be a mismatch. So here different currency comes means we have foreign exchange involved. Forex is involved. So when such mismatch is there, so condition B and C are there, then another factor has to be brought into the formula. That factor is called HFX. That is haircut for currency mismatch or forex. So that is a haircut of currency mismatch. So that is a constant number, a constant percentage, which is 8% given by RBI. If there is currency mismatch of any currency, whatever the currency between the exposure and this collateral, the HFX value is 8%, or we can convert it to 0.08. 8 divided by 100 is 0.08. So either you take 8% or you take 0.08. Am I clear up to this? Yes or no?
Yes, sir. Yes.
Yes, sir.
Sir, is that percentage which we are considering while doing hedging, sir, the same percentage, or this is different?
If you are taking
The
8% for whatever percentage given taken for hedging, I do not know, because I am not in the dealing part, and treasury I am not dealing. This is for capital calculation. This percentage is prescribed by RBI. This is 8%. Okay. This is for capital calculation. HFX is taken as 8%, which is for currency mismatch. Okay. Now, second thing which might happen, second mismatch which might happen, it is this was for currency. The first one is for currency. Second might be happen for the tenure or tenor, whatever you call it. That is the time period. So time period, suppose exposure is for a period of 4-year loan is given, and collateral is available for 4 years. That means there is no mismatch here. So in case of this same terms are there, there is no mismatch. But whenever exposure is 4 years, but collateral is available is for a lesser period than the exposure, then we call it a tenor mismatch. But when sometimes 3 years exposure will be there, but 4 years collateral is available, this is not at all a mismatch, because our exposure is at risk. So 3-year period is less than the exposure period. So this cannot be treated as mismatch. So only mismatch will be when the collateral available is less than the tenor of the loan. Because after 3 years, 1 year will be totally risky. So that's why it is called tenure mismatch. Okay. So for such tenure mismatch, another factor has to be taken, which is called maturity factor, or MF. Okay, so this AMF is calculated as, this is also a fixed thing, which is calculated as small t minus 25% divided by capital T minus 25%. Or I can say, I can write it this, or I can write small t minus 0.25 capital T minus 0.25. Either this or this, same thing. Where the small t...
Sir, maturity factor, please pardon, sir.
Yeah?
Maturity factor, sir, please pardon, sir.
Maturity factor?
Actually, again, explain.
Explain what? This is a formula I am telling. What is there to explain? I am explaining right now. I just written the formula. T minus 25%, T minus 25%. So small t minus 28%, capital T minus 28%. I was going to explain what is small t. Small t is the tenor of collateral. and capital T is the tenor of exposure. Clear? Here it is written everything. There is nothing to explain more. This is the exposure I have given for currency mismatch. This is the tenure mismatch. So you can read and understand which is the mismatch. Mismatch is here only, this one. When both are same period, there is no mismatch. When the collateral is lesser period available and loan is more period, then there is a tenure mismatch. So whenever tenure mismatch is there, another factor has to be taken, that is called maturity factor, where the formula is small t minus 0.25, capital T minus 0.25. Small t is the tenure of collateral and capital T is the tenure of exposure.
Sir, this kind of mismatch is happening.
Means?
Collateral mismatch or time tenor mismatch is happening. Normally, we are covering the collateral as per the term of loan only.
See, if it is not happening, then why Basel or why RBI will tell that you have to take this maturity factor?
That is okay, sir. But can you elaborate some example so that we can have a knowledge for that?
Suppose you have taken a bond of any corporate. Corporate bond has been taken as security. And the bond matches before the loan. So what will happen? So your security, suppose you have given somebody 1,000 crore. Okay. Where
that is an collateral.
Suppose 1,000 crore loan has been given, where 200 crore is given as house property. And 700 crore has been given as a government, say government bond or corporate bond, which are matched. So this loan is given for a period of 5 years. This is maturing in 3 years. So is it not happening? Or you will say that no, it is 3 year only. I will not take this as a collateral.
But after that 3 years, the borrower will have to arrange for another collateral. That
is up to you. You are lending. You take the risk. You decide. RBI is not bothered about what you are deciding. RBI telling that if such thing happens, you do such things. That's all.
Okay. Thank you.
Okay.
Thank you.
You don't take it, nah. You don't take it. You take the full security. There is no problem. You don't have to come to maturity factor, HFX, HE, HC is not required at all.
Okay.
But
okay, sir.
Every bank will not follow your rule. Nah? Some bank will follow some other rule. So for them, everything there. We have to look at, say, regulator has to look into every possible angle to save the bank.
Yes.
Okay.
Yeah.
Now is it clear? Entire thing is clear?
Yes, sir.
For anybody, any doubt, you tell me. Otherwise, I'll go to the formula and we'll do the name.
Tenor of, sir, so can you explain the small t is tenor
here it is written collateral.
Sir, what we will take the 25% of what?
You take it is a number 0.25 I have written here.
Yes,
what
but
is
of what? Of what?
I will see. What is this? Suppose you take this case. What is the small t here? What is the small t?
Type of collateral.
Tenor of collateral.
How much is the small t? How much this small t is?
3 years.
3 years.
3 minus 0.25 and capital T is how much?
4 minus 0.25.
So how much it becomes? 2.75 divided by 3.75. Where you are taking percentage? This is a number it becomes. Maturity factor becomes a number only. Is it clear? Okay.
Clear, sir.
Okay, it is a simple number. It becomes a number. Well, that's why I have taken it as a number 0.25. Instead of 28%, I have converted to 0.25. Here also I have converted 8% into 0.08. So these are numbers only. Don't get confused. When I will write the formula, you will be clear. So can I write the formula?
Yes.
So how this to be calculated?
Sir, previous slide. Previous slide.
Previous slide I have erased. Whatever is there, I erased. What do you want?
Actually, I want to know if the exposure is for 3 years and collateral is for 4 years.
In that case, there is no mismatch, na?
So no need to calculate MF.
See, while what we are doing, what is the course name is?
Risk management.
Risk management. If loan is given for a period of 3 years and collateral is available for 4 years, where is the risk, you tell me?
No risk.
No risk means there is no need to manage the risk. No risk management. So there is no mismatch, no tenure mismatch. Clear?
Yes, sir. Yes.
When there is a risk only, we will take the care. When there is no risk, why should we take?
Yes.
Okay.
Yes, sir.
Oh, fine. Now I will let you know I am not writing the complicated formula which is given in the book. You follow the simple formula I am writing so that it will be easier for you to understand. There is a complication of formula. Formula looks very complicated. It is simple, but it looks complicated. So do not go into that formula. I will just give you that formula. I divided into just 2 steps. Okay. So now we know that E is what? E is denoted by
Exposure.
G is denoted by
Collateral.
H E is the
H is
Haircut of collateral exposure.
HC is the
haircut for
Haircut of collateral.
HFX is
haircut for foreign currency.
so currency mismatch haircut. Okay, and tenure mismatch is taken as MF or maturity factor.
Maturity factor.
Okay, now again remember, when we adjust the exposure with haircut, we always add the HE with the E, and with collateral it is always deducted. That is the basic formula you have to remember. Okay, now HFX is again to be deducted. So HFX, whatever is there, it will be deducted, but it is not applicable to the exposure. It is applicable to the collateral only. Okay, so when you are adjusting collateral, HFX will be deducted. Okay, now when you adjust this exposure into HE with the haircut of exposure, we denote that letter as E asterisk. When collateral is adjusted with haircut and HFX, that letter is called C asterisk. Okay, that means asterisk means haircut adjusted collateral. This E star or E asterisk means haircut adjusted exposure. So these are the terms. Now, first we will do, so net exposure, we are finding the net exposure. What will be the net exposure? Net exposure will be equal to haircut adjusted exposure minus haircut adjusted exposure minus haircut adjusted collateral. So we can say, I write clearly, E star minus C star. This will be the net exposure. This, if there is a haircut given, you adjust it. Otherwise, this will be the E only. So from the exposure, we are deducting the haircut adjusted collateral. So that becomes our net exposure. Okay. So first we will see how to arrive at this collateral, a haircut adjusted collateral. First thing we have to find that one. After that, when we arrive at this, then we will deduct that from the exposure or exposure, haircut exposure if it is there, or only from the exposure we will deduct the collateral adjustment of after the adjustment of haircuts. So C is the haircut adjusted collateral equal to C. C is the amount of collateral here, okay, multiplied by 1 minus haircut of the collateral minus haircut for the currency mismatch multiplied by maturity factor. This is the formula. You write it down. Original collateral value multiplied by 1 minus haircut percentage minus currency mismatch, if it is there, that percentage, into maturity factor if there is a tenure mismatch. And maturity factor, I have told you, what is the formula?
A minus
T minus
0.25.
0.25 divided by capital T.
Small t minus 0.25, capital
Divided by
T minus 0.25. So small t is collateral,
Right.
this
Collateral.
collateral, this is for exposure. Okay. So after getting C star or C asterisk, then we'll get the net exposure as net exposure will be exposure minus C asterisk. Or if there is adjustment to the exposure also for haircut, you can write E asterisk minus C asterisk. Clear? This formula you remember, I will do one numerical so that it will be easier to understand. Any question you ask me before I go into the...
Actually, this formula C star equals to C into 1. Actually, C star, you are denoting what? C star?
Again, you are asking. I have already told you, this is the C is the collateral. C star means haircut adjusted collateral. E means exposure. E star means haircut adjusted exposure. We are adjusting the haircut here. Haircut and mismatch, all things are adjusting here. So this is the haircut adjusted collateral.
Okay, sir.
Okay.
Sir, HC,
So how to calculate
haircut of
the
collateral.
exposure?
Hello, how am I pradam?
I
Hello.
could not. So there was an overlap of voice. Just one by one, you asked me.
Good morning, beta. और बताओ.
Oh, madam, you are telling me or you are telling to somebody else?
अच्छा अच्छा आज तो लेट जाना है ना डैडी के साथ हम भूल गए थे.
Oh, madam, honor 8x.
हाँ मतलब वैसे डैडी के साथ जाना ना.
Madam, honor 8x. You are in a class. Madam, honor 8x. You have not written your name also. I cannot address you. Okay, you ask the question, sir. What you are asking?
So that exposure adjusted haircut, that E star, that is how to be calculated.
A simple thing, na? Suppose I have already given, na? Suppose 100 is the exposure and HE is given, say 5%. That means 100 plus 5% of 100 is 5 only. So 105. It becomes,
okay.
It is added. 5% has to be added. Simple.
Okay.
Say that means E star formula I will just tell so that you can understand. E multiplied by 1 plus HE. Simple. This is the formula. Here 1 minus HG you are telling with collateral. Here 1 plus HE means 100 plus 5%. 105% of the original. Either you add 5% or become 100, 105% of 100 equal to 105 only. Right? So this will be this formula. E multiplied by 1 plus HE. Any other question? Nothing? So can we do one exercise numerical problem so that it will be easier for you?
What is G, sir?
What is?
G.
Arey yaar, can you understand Hindi?
No,
Do you
sir.
understand? No, sir. So Ramayana is over. You are not now asking who is Sita or who is Ravan.
No, G and HC, sir.
Where G is there? Where G is there?
E, sir. G and HC.
I have already 100 times might have told HG 100 times while last 10 minutes. And HC also I have told so many times. Now you are asking means you are sleeping or something like that. You are
No,
not
sir.
focusing on the class. Then I might have, you ask anybody whether I have not explained what is HE and what is SC for the last, I might have told these two for minimum 30 or 40 times. H
HE is
denotes,
haircut exposure and HC is haircut collateral.
see how CC understands it. H is haircut, E is exposure, H is haircut, C is collateral, H is haircut, this is foreign exchange or currency mismatch. Now it is clear?
Okay, sir.
So
Yeah.
I think you are totally confused. It will be a problem for you, I am telling. If you
No,
do
sir.
not focus on the class, it will be very... See, I have 30 times I might have explained what is HE, how it is calculated, how HC is there, what is that, and you are forgetting all things.
Yes,
In
sir.
that way, I can't help you, brother.
Sir,
Okay,
every
now
time-
we'll do a problem so that it will be easier for you. So this is the
Okay.
first problem. So here you read the problem, an exposure of 500. So E is 5. Simply you write down so that it will be easier. With a financial collateral of A plus debt security of 150. So C is 150. So both are in rupees. That means there is no currency mismatch. No currency mismatch. That means we know that HFX equal to 0. When currency mismatch is not there, either you take HFX or you do not take HFX. HFX becomes 0. And the haircut of that collateral is given as 6%. So HC is how much?
0.06.
0.06. Now tenure of exposure is how much? 3 years. So this is capital T. And residual maturity of the financial collateral is 2 years. This is small t. Now first find out haircut adjusted value of collateral. So what is the formula of C asterisk? C multiplied by 1 minus HC minus HFX multiplied by maturity factor. So C is, how much is the C?
150.
150.
150 multiplied by 1 minus HC is how much?
0.06.
Minus 0 into 2 minus 0.25 divided by 3 minus
3
0.
minus 0.25.
So how much it will be? 150 multiplied by 0.94 into 1.75 divided by 2.75. Now tell me how much it is coming. $80 something, $89 something.
Okay,
89.72. This is the first answer. Haircut adjusted value of collateral. So we have arrived after adjustment of haircut, currency mismatch and tenure mismatch. All things taken care of. So this much is allowed to be reduced from the net, from the exposure. So second question is asking what is net exposure. So there is no haircut for the exposure given. So exposure is full taken. So net exposure eligible will be E minus C asterisk. So how much E is how much? 500 minus 89.73. So net exposure becomes how much?
410.27.
So this is the amount of exposure to be taken for calculation of capital. Yeah.
Net exposure also we have to calculate E asterisk and minus E asterisk. That is E into 1 plus HC.
No,
That we
where
have
it
to
is
calculate.
given? E into?
Net exposure E asterisk minus E asterisk.
So here there is no asterisk, na? There is nothing for haircut. You can take E asterisk as 500 only. Because E asterisk will come when there is a haircut given for exposure. There is no haircut given. Is there any haircut given for the exposure here?
Sir.
Only here haircut is given for the security. So exposure do not have any haircut. So E equal to E star also, E asterisk. So the same thing. Is it clear?
Okay.
Okay.
There is no haircut adjustment.
If it is in exposure haircut, they will be giving separately. Not
Yes,
like
that
this.
will be.
It is not
An
common
exposure,
for both.
Yeah, no. An exposure of 500 with an haircut of this much is secured with. So this is another sentence. Okay. So there is no haircut mentioned for exposure. This haircut is meant for only security. Is haircut of exposure, or the question might have given the exposure of 500 has a haircut of this %, is secured with a collateral of this much with this much a percentage. Or it can give simply exposure 500, HE 3%, EFC 150, HC 6%. This type of question might also be asked. Here words have been there, sentences made, or simply they will ask in the tabular column. These are the things available. You find the net exposure. Okay, clear? So
Yes.
two things we have arrived: haircut adjusted value of the collateral and net exposure we have arrived. Now third is asking about value of exposure at risk. What does that mean? That is a little bit confusing thing. Just you remember, this means value of exposure at risk. So we call it V at R. Value of exposure at risk is equal to the original collateral value minus haircut adjusted collateral value. C minus C asterisk. So it should be 150 minus 8973. So how much it will be? 2760. So 60.27 is the value of exposure at risk, because this is the amount which is not allowed for reduction from the exposure. Only out of the total collateral of 150, this much is allowed to be reduced from the exposure. This is the amount not allowed due to this haircut as well as other adjustments. So this is called the value of exposure at risk. So this is the amount for which we have to maintain the capital from the collateral. Okay, is it clear? So that I will go for another question so that.
Yes, sir. Clear, sir.
Clear? So now you do yourself. I am erasing it. I'm going to next question.
So that VER, that concept is total collateral minus that exposure at risk, that is 60.27 is free from risk, or how it is? Value of
this I have written in the formula, C minus C asterisk, simple. Here C is 150, C asterisk we have arrived this much. So formula I have given you, na? C minus C asterisk. Original collateral value 150 given in the question. Haircut adjusted collateral becomes 8973. So you deduct 8973 from 150. This becomes 60.27. Okay. If it is okay, then I'll move to the next one.
Yes.
Okay,
Sir.
sir.
Okay, sir.
Sir, if there is currency mismatch, then straight away we have to take that HFX value as 0.08.
Yes, always. That is constant. Like you are taking this 0.25 also, that is constant. 0.8 also constant. That doesn't change.
Okay, sir.
If it is there, you take 0.08. If it is not there, simply 0. Okay. Now do the next problem. Here you add here one thing. So you take this. Don't take it as a 500 million. It will be very big. So you take 5 million. Exposure is take 5 million, and finally you take here $1 US dollar equal to say 80 rupees. Rupees 80. $1 US dollar equal to 80 rupees. You calculate. Now you do this exercise.
The debt security also 200 million or 2 million, sir?
Yeah, this is, you read it. You read it. Only I have changed for the exposure. I have not changed for the security. So what is the exposure? What is the amount of exposure?
5 million.
Million.
$5 million. So we have to convert it to one currency. So if we convert it to rupee, how much rupee will be there?
400 million. Sir, it is already in millions, sir, collateral also.
So we have to convert it to rupee, na?
Sir, okay, sir.
Okay, because
Both are we have to convert, sir.
Rupee only. The same thing comes, then we can adjust that.
Rupees
400 million. Collateral is 200 million. Okay, but that is a currency mismatch. We are just calculating purpose. We are converting this, but currency is in US dollar and a rupee. So HFX is 0.08. Haircut of collateral is
0.04.
whether there is any tenure mismatch. Tenure mismatch is there.
No, sir.
No, sir.
So maturity factor will be taken as 1. Or you omit this maturity factor. If you leave the maturity factor, it's okay. Otherwise, if you are multiplying, then take it as a 1. Because maturity factor is a multiplication, so you have to take 1. HFX is a deduction. So there you cannot take 1 if it is not there. Okay. Either it's 0 or 0.8. Maturity factor will be either there, the T minus thing, or this one. Now can you calculate the haircut adjusted collateral? How much will be this?
The
3 multiplied by
166, sir.
Pardon?
176 million.
76, sir.
176. So you 176 million rupee. Okay. Everybody is getting this answer?
sir.
Yes or no? Tell me so that I will confirm that whether the because I don't know. I have not done this, so you
Yes,
will
sir.
tell me.
Yes,
So
sir.
if 4 or 5 people say yes, that means this is correct. Okay. So rupees 176 million is the haircut adjusted collateral. Now tell me what is the net exposure?
224 million.
224 million. So both together becomes 400. Okay. Okay, fine. Then what is the value of exposure at risk?
24.
Only 24, right?
Yes, sir.
So Vikas Singh, Mr. Vikas Singh, can you please mute your mic? Vikas Singh Raghuvanshi. So you have done this haircut adjustment problem. So there is no problem. Okay. Now with this we complete the credit risk part. Is it clear? Credit risk part is completed. Any doubt on this, you ask me now, otherwise I'll go move to next one. So our credit risk, which I have explaining from the yesterday, credit risk capital charge is complete. How to calculate capital for credit risk? With that formula, I have already explained everything. Any question comes for this, whether theoretical or numerical, you can do it. Okay?
So how it will come 176? Can you explain that one?
What is the formula? C asterisk formula.
C into 1 minus HC minus HFC.
Okay. Into?
Maturity factor.
Okay. So what is C here?
200.
200. What is HC here?
0.04.
What is
Minus
HFX?
0.08.
HFX is 0.08. Maturity factor is 1.
HFX we are calculated based on the conversion factor. So
I have told you HFX is equal to 0.08 is a constant number given by RBI. 8% is the only thing.
Okay.
How many times I am going to tell you, I don't know. How you are asking again and again. So this means 200 into 1 minus 0.18.
Okay, sir. Got it, sir.
So 200 into 0.88 or 88% of 200. So it becomes 176.
Yes, sir. I got it, sir. Thank you.
Simply you can do it in your head also. Simple thing you can do it head, because see 4% is the haircut for security, 8% is the haircut of for currency mismatch. So together it becomes 12% haircut. Total haircut is 12%. So simply 88% of the security is the net haircut adjusted. So total security is 200 into 88%, 176. Without doing the formula, you can do it. 4% haircut for the collateral, 8% haircut for the currency mismatch. Total haircut is 12%. So from 200, deduct 12% haircut. So 88% is to be there. So 176. It can be done easily through mind and within 10 seconds you can do it.
This is better method, sir, compared to us.
Up to you. Whatever, sir.
Method, sir.
How you do to get the correct answer, that matters. Whether you go for 10 steps or you do it one step in your mind, that is up to you. Okay, that is your talent how to do. Okay, the next one I'll discuss about what is the expected loss. That is one thing we have to remember. How to calculate this expected loss for any kind of say exposure, like credit exposure or say investment exposure. How this expected loss is a term which is there in the risk management. So expected loss is a function of three things. That is, three things are called PD, LGD, and EAD. PD is the probability of default, LGD is a loss given default, EAD is exposure at default. So what are these things? Just one by one I'll understand. I'll make you understand. Probability of default. PD is the measure to find out the likelihood that the borrower will default on loan repayment over a given time horizon. Simple thing. What is the probability that this borrower may default in repaying the loan or repaying the installment? So that will be decided by the bank for each type of borrower depending on various factors related to the borrower, like borrower's character, borrower's credit history, borrower's credit rating, borrower's economic condition of the market where the business of the borrower is done, or it might be industry-wise performance, what industry he is doing business, or sometimes economic condition of the country, which affects the market of the business. According to that, a percentage can be given by the bank depending on all the situation. Say that percentage may be ranging from 0 to 100%. So PD is expressed in a percentage from 0 to 100%. 0% means he is never going to be deferred. Our loan is fully secured. So PD will be 0. 100% means there is a chance that tomorrow he will default. So accordingly, a range of percentage can be given as 0 to 100% by the bank on a single loan. So that is called PD. Second is loss given default. It measures the proportion of the exposure that will be lost if the borrower defaults. That means what? From this percentage, we can assure that how much up to what percent the borrower is going to default. And after that, we'll see if at all he defaults, then what is the amount of default will be left with us. That means if there is some collateral available to the bank, after adjustment of those collaterals, whatever the amount will be left over, that is the LGD. That means after adjustment of value of the collateral available with the bank or any other amount which can be recovered from the borrower at the time of default, that has to be adjusted, and rest amount, which is a risk amount, which is a loss to the bank, that is called loss given default. This can be also given as a percentage. Okay. Third thing is exposure at default. That means it measures the amount of facility that is likely to be drawn in the event of default. That is amount of loan outstanding at the time of default. Means after adjustment, what is before adjustment, it is the loan outstanding amount. Means what is the original amount of loan which was outstanding at the time of default, but before the adjustment of collateral. So that amount is called exposure at default. That is the amount. Here it is not a percentage.
Not clear. So last one is not clear. Exposure at default.
Suppose a loan was given for 100 rupees. Okay. Security available is say 80 rupees. And you say that 50% is the probability of default. That means this is the exposure at default. 80 rupees security available. So loss given default will be how much?
20%.
So loss given default will be percentage wise you have to calculate. So we can say that after adjustment of this 80 amount, what is left? 20 only. Okay. So EAD is how much? EAD is 100. Loss given default is 20. Probability of default is 50%. Is it clear to you?
Yes, sir.
So outstanding loan amount at the time of default before adjustment of the collateral or any other amount recovered, that is the exposure at default. Okay. So expected loss formula is EAD multiplied by PD multiplied by LGD. Okay. So this LGD has to be converted into percentage. I have just given an example where I have given the amount, but that has to be converted into a percentage. So I'll just give an example how this LGD will be asked to convert into a percentage, then you will find out expected loss. So it will be given that suppose a loan has been given for rupees 50 lakh. 50 lakh loan is given and collateral security available is say rupees 20 lakh. And probability of default is given as say 40%. Now, the question will ask you find the expected loss. So expected loss, we know formula is PD into LGD into EAD, or EAD, PD, LGD, whatever it is. So the multiplication of three parameters, PD, LGD, EAD. Now PD is given here. EAD also we know 50 lakh, but LGD we do not know. So how to find LGD? So LGD is computed by the formula 1 minus a recovery rate. 1 minus recovery rate. So what is this recovery rate? You have to find out. The recovery rate is the percentage of amount recoverable at the time of default of the total exposure. So what is that percentage amount recoverable from the borrower at the time of default out of the total exposure? So out of the total exposure, what is that amount recoverable? So we can say that recovery rate equal to 20 is recoverable. This is the collateral secured recoverable out of the total exposure, that is 50 into 100. So it becomes how much? 40%. Or we can say this is 0.40. So PD is also given as 0.40. So now your LGD becomes how much? LGD becomes 1 minus 0.40, that is equal to 0.60. So your expected loss will become 50 is the EAD, 0.40 is your PD, and 0.60 is your LGD. So how much it will be? 50, 40% is 20, 60% is 12. 12 lakh will be the answer of expected loss. Clear? If any question is there, ask me. Otherwise, we'll stop.
Collateral security amount will be given. That has to be taken as the recovery amount, right? Recovery rate for calculation we have to take.
I've written that. Nah?
Yeah.
Recovery rate is the percentage of amount recoverable at the time of default out of total exposure. What is the percentage of recoverable amount or recovered amount to the total exposure? So recovered amount is 20, total exposure is 50.
50.
What is the percentage? How much is the security amount is the percentage wise of this loan amount? That is the 20 is how much percentage of 50? If nothing is there, we can stop here. So next class we will complete the risk management, where I will discuss operational risk and market
So can
risk.
you please explain this 50?
What 50?
PD,
PD is not 50. Here I have written in a different sequence. Here I have written in different sequence. I have written in EAD into PD into LGD. So that is a conclusion. Okay.
So EAD is coming as 50.
Here alone, na? EAD I told you, na? The amount which outstanding in the loan amount at the time of default before adjustment of security. So what is the loan amount? That becomes EAD.
Okay, sir. Thank you.
Okay. Sometimes question will be also asked. Question will be given. Suppose EAD is also given a percentage. So EAD is say 90% will be given. Also loan amount will be given. In that case, you have to calculate EAD as 50 into 90%. So it becomes 45. Here nothing is given, so you have taken as 50. If EAD is also given in a percentage, then you will calculate that percentage amount for the EAD. So that will be in amount. EAD is always in amount. PD and LGD are in percentage. PPT I will share after the next class. Next class we will complete risk management, then I will say.
Sir, tomorrow no class, sir. And Sunday is there now.
So Sunday your classes will be there. Some other classes will be there. Huh? You focus on that. Huh? Otherwise, everything is available in the book and material. Same thing are available. You read those things first. I will provide a PPT after the entire session is over. Same thing happens in the balance sheet management, because balance sheet management is also assigned to me. I will take. So PPT will be provided after the balance sheet management module is complete.
Sir, actually there was a link failure between, sir. So adjusted exposure, just a brief idea, sir. I have
adjusted exposure means?
Initially you are explaining, no, sir, how it is to be calculated that.
Adjusted exposure. Adjusted exposure, when I was telling, it is about CCOD and term loan, demand loan. Okay?
Okay, sir. That
CCOD is a running account. So whatever the balance is available on that day you are taking, that balance has to be taken. Suppose sanction limit is 100, but debit balance as on that is say 80 rupees.
Okay.
So you are taking the exposure 80 rupees, but next day there is a possibility that this borrower can withdraw to 20 also, so that it becomes 100. So you are not taking 20. So in this case, RBI says that for CCOD thing, these are called unrun or unavailed amount. So you have to add 20% of that unavailed amount.
Okay.
Okay, so here how much it will be? 80 plus 20% of 20 means 4. So instead of 80, you have to take 84 as the exposure amount. Okay. Similarly, for term loan, same thing happens. Sanction limit is 500. 100 has been already disbursed. Another 200 will be disbursed within a period of 1 year from the date of disbursement. The rest amount will be disbursed after this 1 year period, whether second year, third year, fourth year, fifth year, whatever it may be. So in this case, the adjustment is original, whatever you are already disbursed 100 plus the 20% of the amount to be disbursed within a 1 year period. That means 20% of 200 plus rest amount, whatever it may be, 50% of the rest amount. So that 200, 200 and 100 becomes 50. So 500. So total is 500 only. So here 100 plus 20%, 200 is 40 plus 100. So your adjusted exposure will be 240 instead of 100. Is it clear?
Okay, sir.
Okay.
Clear, sir. Thank you, sir.
See, somebody is asking what is value of exposure at risk. That is the formula. Value of, see, there is no, I have written that as V at R. I have written that as value of exposure at risk for your understanding only. There is no such term used in your book. So basically the question will be asked as value of exposure at risk. So this equal to your original collateral minus haircut adjusted collateral. Okay, see you tomorrow. See, not tomorrow, next class.
Sir, your contact number, sir?
I am in the group, you can find it.
Sir, please share me, sir. I didn't get that.
No, this is private, very private. Private, I cannot share it. So see, you are not allowed to call because I will not pick up any call. Okay, I am sharing my number. Only WhatsApp.
Okay, sir. Sir,
This
in
is
this
8.
chapter,
This is 8.
time zone problems is there, sir? Can you explain in further classes?
Time zone for what? That vertical disallowance and horizontal disallowance.
Duration method, time bonds, horizontal disallowances, sir.
And the market risk. That
Yeah.
I will discuss in market risk about the three zones are there. Zone 1, Zone 2, Zone 3, vertical disallowance and horizontal risk. How they are calculated for market risk capital calculation. Yes, I will discuss that.
Further classes we can discuss that.
Now, next class we are going to end this risk management chapter where I will take operational risk and market risk to complete the risk management. We have completed credit risk. Only 2 things are left: operational risk and market risk left. And there I will discuss. But this is very, very complicated. I think 90% people will not understand this.
Actually, last time one question will.
Yeah. So I know. I will make it understand you people how much you can digest. That is my doubt, because this is totally complicated method. I will try to explain everything. How much you can take, that depends on you. I will explain that. No problem.
Okay, sir.
Sir? Sir, actually, I want some problem for solving. So can you get can this provided in Vigyan app?
Yes, already in Vigyan there are 300 to 400 numerical problems are there, which are posted by me only. Okay. That is there. You do those things. Now start doing those things.
Okay, sir. Okay.
You have paid the entire course fee, na? Today is the last date.
Okay, okay.
So have you paid or not? Yes or no? You tell me.
I will pay today.
If you are not paying, then tomorrow your ID and password will be deactivated so that you will not be able to log in into IBS Vigyan. Okay. So please pay. Please pay. Everybody pay. Otherwise, tomorrow it will be locked.
Okay.
Okay. That is the instruction from IBS. Normally, see, you are a banker. You have money. You are getting salary more than 40, 50,000. What is there? You are trying to pass the examination. You do so much wastage of money by spending money for learning something. You are delaying the payment. What is the point? I don't understand. First, Saraswati will bless you if you pay the money in a one shot.
Definitely.
Okay.
Definitely.
Okay. Okay. Thank you. Thank you. See you in the
class was so good, sir.
Thank you. Thank you. See, my class was good or bad, that doesn't matter. Only matter that how much you are understanding, how much mark you will secure in the examination. I hope that you will secure more than 60% mark. Okay. Best of luck. Thank you. Thanks.